everyone, and welcome to another Edge Capital video podcast. Today, we'll be discussing current market conditions, the evolution of digital asset, infrastructure, and overall market sentiment. For those less familiar with Edge Capital, we are a $500 million investment manager focused on sophisticated CFI and DeFi trading strategies. We actively participate in both on-chain and centralized markets, providing liquidity and managing risk across cycles. I'm Caitlin Kalafsky, and I focus on investor relations at Edge Capital. Joining me today is Vadim Khramov, founder and CIO of Edge Capital. Before we begin, a quick disclaimer: this video is for informational purposes only. This is not investment advice and not an offer to sell or to purchase any securities. Please refer to the full disclaimer at the end of the video. Vadim, thanks for joining us today.
Thank you so much, Caitlin.
Let's start with the big picture. How are you currently assessing the market? Where do you see valuations across digital assets? And what do you think is driving investor sentiment right now?
It's a very good question. I think there has been a big reassessment of valuations of digital assets. If you see it in the past half a year, the majority of the tokens go down 50 or 80% down from the highs. Bitcoin went to sub $70,000 from more than 100,000 within 6 months. So there is clearly a question from the market: how should we look at the tokens? How we should assess the valuations? There are two narratives. Number one is, why don't we price tokens as equities, right? So there is a big drive understanding what is really the revenue generating element behind each company that is blockchain space. Those companies who produce real revenues are very successful. Look at companies like Aave, Hyperliquid, Compound, Curve. They're all generating yield. So there is a natural demand for their tokens because they are producing revenue. The second block was about the valuation of chains and different projects that don't generate revenues. And people start questioning themselves: do we really believe that these new blockchains are actually, do we need them, right? And that was the reason for a large reassessment of the valuations. And the second big block was clearly related to a large risk of, in the tech side, AI-driven pressure on global fintech, including Bitcoin. For that reason, I would say there was a big sell-off that took place.
Let's talk about regulations. On March 23rd, 2026, the SEC and CFTC jointly published guidelines that are establishing the first comprehensive federal taxonomy in crypto assets. Can you comment, what do you think the major issues that were addressed and why is it important view on that?
Of course, we think this is one of the most important piece of guidelines that came from the U.S. regulators in the past years after clearly the Genius Act. This regulation clearly defines a few things. First of all, they define 5 categories. The first one are digital commodities. Those are crypto assets. Those value derives from operational blockchain networks. These are clearly Bitcoin, Ethereum, Solana, Ripple, Cardano, Avalanche, Chainlink, and a few others. So these are really just digital commodities. The second definition is digital collectibles. These are mostly trading cards, meme coins, art, music. So effectively all these things that we think through that really has to be a form of NFTs, right? So there is a clear definition: they are not securities. They're digital collectibles. The third block, they call digital tools. These are membership tickets, credentials, identity badges, actually everything we need as a form of an AT to prove some ownership. These are not securities either. Examples can include ENS domain names, for example, right? The fourth big block will be stable coins, right? So they were clearly regulated by the Genius Act, but they would by definition excluded from securities by nature. And the last component, number 5, would be digital securities. This is clearly tokenized stocks, bonds, investment contracts that clearly fall into the category that regulators want to regulate. So this is clearly a big milestone for the whole industry. Now we can say There are no concerns about touching these assets. There are no securities. They're commodities, the majority of those. And those that are securities are very clearly specified. The second big block was really related to activities and protocols that were cleared, in the sense that now there is no question if staking or wrapping of this type of activities are actually broker-dealer business or not. So what was really clarified? First of all, so proof of work validations are not security transactions. Very important. Any type of staking, proof of stake, any type of, let's say, staking of Ethereum, Solana, non-securities. And this is not a brokerage business, right? So liquid staking tokens that represent deposited non-security crypto assets are also non-securities. For example, staked Ethereum through Lido, or RSETH through Kelp, or EE through Etherfi. These are non-securities. Also, what's important, any type of wrapping, let's say wrapped BTC or CBBTC or wrapped ETH, do not create securities either. So I think last component is very important, that was related to airdrops. They're not securities either if they're not related to generation of securities contracts. So I think in short, this big piece of legislation clearly identified and clarified the fact that all the custodians in the US now can safely stake assets, generate yield without requirements of broker-dealer licenses. In the past, the enforcement was by basically SEC was providing these guidelines through enforcement. They were sending letters to staking providers asking them to get a broker-dealer license, right? Which is frankly like ridiculous to some extent. Now it's all very black and white. These guidelines will serve as a new path for the industry to move forward.
And you've recently traveled to Mar-a-Lago, Denver, New York, and met with groups including the World Liberty Financial. What were some of the key takeaways from those conversations, and what seems to be the top of mind of institutional investors today?
Very good question. So we met with a lot of, I would say, very senior level people in the Trump administration. We met a lot of senior level people in the TradFi business in New York, right? Actually, the camp is split. On the one hand, you look at the crypto bulls who say, look, you have legislations in place. It's all getting only better. We never have this framework in the past decade that clearly defines securities, commodities, what you can do with staking, and so on. Now it's all black and white, very clear. This is extremely positive. Payments, they're all happening, exploding, right? This is all good for users. Passing the yield from T-bills, from money market instruments to depositors is good for users, right? Instant payments without paying $25 or $45 wire fees is good for users. So this is all a massive advantage that has been taking place. Tokenization and distribution is all amazing. So from that perspective, there is a very strong bull camp saying that fundamentals have been improving. On the other hand, there is a camp that is saying, look, most of this project will not be here, and the valuations were extremely high, billions of dollars for companies that are not generating any revenues, or some chains that are not generating any revenues. And they're totally right. I think the truth is in the middle between all of them, and the truth is effectively that in the crypto business, the majority of the tokens are still early stage venture companies. So in this case, you should expect a few things. Number one, 9 out of 10 of them will not be here in 5 years because it's a venture business, it's early stage venture. Number two, volatility of these tokens will be extremely high because this is a small cap stocks. And number three, those who actually generate revenue will be treated as equities. So this is, I think, the mindset that we've seen across everywhere. And but I think structurally people are very positive on the industry, except that we will see a lot of changes taking place going forward.
Okay, let's shift to market infrastructure. How do you see the brokerage, custody, and staking landscape evolving, and where do you think the biggest opportunities are emerging?
That's a very good question. So we spent some time at iConnections, where it's the first time in my life when I've seen so many TradFi brokers launching crypto desks. It's the first time in my life I've seen biggest custodians like BitGo, also companies like Chainlink, having very big stands at iConnections, which is one of the most prestigious events over there, right? So which tells us one thing: TradFi American brokers are all building crypto desks, right? Number two, they're all looking to do futures. Number three, they're all looking to tokenize assets to make faster distributions, faster settlement, distribution of assets. On the other hand, you have guys like Anchorage and Bitcoin getting bank licenses in the US, such that they can not just custody assets, they can also do a lot of other things on the top of this. They also got clearly qualified custodian licenses, and all of them are opening brokerage desk for crypto side. So we haven't seen it 2 years ago, we haven't seen it 3 years ago. I think this dynamic is very positive. We have a lot of big brokerage desks setting up completely separate crypto desks within their companies, and they're bringing all the top people from crypto brokers who are switching back to them. So we think this dynamic is very new, it's very positive, and we think it will help the industry grow.
Well, Vadim, thank you for sharing your valuable insights, and thank you for your time today.
Thank you so much for inviting me. Appreciate it. Bye-bye.